I'm Paul Meehan, President of Edgemoor Investment Advisors. I want to begin my talk by addressing two questions that we are asked with increasing frequency as stocks hover near all-time highs 3 years into a powerful bull market. The first question is now a good time to be investing in stocks, or would I be better off waiting for prices to fall a bit first? The short answer is yes. It still makes sense to invest, even when stocks are at all-time highs. The average market return 12 months after an all-time high is more than 10%. Perhaps counterintuitively, studies show that investing, or, equally important, staying invested, at market highs does not, on average, result in lower long-term returns. The most important reason for this is something you can see in the chart currently up on the screen. The long-term trend of the market is higher. Waiting for a better time to invest may sound sensible, but it amounts to market timing, and we are not aware of any investors who have successfully followed this strategy over the long term. What makes investing when the market is high so difficult, despite what the numbers tell you, is psychology, which exerts a powerful influence on investors. Buying at a market high does expose you to the possibility of buying at the last new high before a correction or bear market. But even buying just before a bear market doesn't ruin your chances for good long-term performance. For example, if you had the misfortune to put all of your money into the S&P 500 on October 9, 2007, the last market high before the onset of the great financial crisis and the bear market of 2008 and 9 that saw the S&P 500 fall more than 50%. That money today would still have seen a total return of more than 500%. This equates to an average annual return for those 18 years of roughly 10.4%, which closely tracks the long-term return for the S&P 500. The second question that comes up frequently today is, how do I protect my gains? One important tool we use to help preserve gains is portfolio rebalancing. If the equity portion of a portfolio has large gains and equities have grown to 70% or more of the portfolio when only 60% is the intended asset allocation, the portfolio is out of balance. Rebalancing, by selling some highly appreciated equities and shifting those funds to less volatile income investments, helps to preserve gains by reducing exposure to equities and thereby mitigating bear market losses. The same conditions that might lead a balanced portfolio to become out of balance can also cause an all-equity portfolio to become too concentrated in certain stocks or sectors, and rebalancing that portfolio by reducing those concentrations can help the portfolio better weather market turbulence. Rebalancing, however, may not be appropriate for every portfolio. In some situations, the need for rebalancing must be weighed against potentially large taxable capital gains that would be generated by the sale of highly appreciated stock. To us, these questions and their answers underscore the importance of being disciplined in maintaining a long-term perspective when it comes to investing. Now I want to give you an overview of our approach to equity and income investing. As many of you know, our equity portfolios are focused portfolios that hold 30 to 35 stocks. Our portfolios are diversified and typically own stocks in each of the 10 major industry sectors. Every year, we believe it's important to remind you of the key components of our equity investment approach. Our bottom-up analysis focuses on a company's fundamentals, such as its price-to-earnings ratio, its prospects for growth, whether it has a strong franchise or a wide moat, its free cash flow, the quality of its management, and whether it has high returns on equity and invested capital. These are the same fundamentals that have guided our investment process since Edgemoor began. Many companies with characteristics like high returns on equity and invested capital have a strong franchise or economic moat. By that, we mean that they have a sustainable competitive advantage that protects their profits and market share from competitors. Moats are particularly important to long-term, value-oriented investors like us because they are a critical feature of long-term stock outperformance. Our income portfolios are also focused portfolios of 20 to 30 investments, drawn from a broad range of income asset classes, including utilities and telecoms, real estate investment trusts, energy pipeline companies, business development companies, and bonds and high-yielding preferred stocks. Selecting investments for our income portfolios is guided by many of the same factors as our equity investments, starting with fundamental analysis of individual securities. The most significant difference is a shift in our starting point for analysis from capital appreciation potential to income generation. Our aim is to find high-yielding securities with strong business fundamentals to support dividend or interest payments, and moats remain an important reference point in our analysis. Some of our income securities are structured differently than a typical equity, and so are analyzed using somewhat different metrics. For example, our evaluation of bonds and bond-like preferred stocks means a focus on balance sheet strength and interest rate risk. Despite all our efforts, we do make mistakes. But experience has taught us we don't have to be right all the time to be successful. For an investor, we believe that temperament is more important than IQ. A successful investor is patient, disciplined, open to new information, and willing to adjust her views in the face of changing facts or circumstances. Now let's take a look at the current state of the stock market. We last had a market correction, and very nearly a bear market, in March and April of this year as investors tried to adjust their expectations for economic growth and stock returns to the new administration's trade and tariff policies. A correction is a decline of 10 to 20% from a recent high. Usually, the market recovers from a correction within a few months or less. A decline of more than 20% is called a bear market. On the current slide, the circles show recent corrections and bear markets and their maximum decline. The first circle is the 2020 bear market due to COVID. The second is the 2022 bear market as the Fed raised interest rates to fight inflation. The third is a brief correction in 2023, spurred by concerns about the economy's growth trajectory. And the fourth is the 2025 correction I just mentioned. You can see that in each instance, the market recovered and went on to new highs. Typically, we have a correction about once every year or two, and a bear market about every 5 years. We may have another normal correction over the next year, and if we do, we expect the market would recover within a few months as it normally does. We do not currently see signs of an impending recession or a bear market. We are well aware, though, that there are challenges confronting our economy and the stock market. These challenges include uncertainty related to the impact of the new administration's evolving trade and tariff policies, difficult international trade issues, especially our trade war with China, our massive federal deficit, and geopolitical issues around the world. Although these threats to our markets and economy remain, in our view, the positives outweigh the challenges facing investors today. The positives include, first, the U.S. economy continues to grow. The U.S. economy's performance coming out of the COVID shutdowns has been the envy of the developed world. U.S. GDP has shown solid growth over the past few years, and that growth, although moderating, is projected to continue. The unemployment rate now stands at 4.4%, higher than 12 months ago, but still low by historical standards, and wages continue to grow. Consumer spending, buoyed by rising incomes and robust market performance, remains strong, and massive spending related to the artificial intelligence build-out continues to support many sectors of the economy. Second, Federal Reserve rate cuts should support the markets. From September of last year until today, the Fed has cut its benchmark Fed funds rate by 1.5%. The impact of Federal Reserve interest rate cuts on the economy is felt most significantly 6 to 12 months after they have been announced. So, it's likely that the economic stimulus from the recent rate cuts should continue well into 2026 and benefit our markets and economy. Third, stock market performance is strong. As of today, the S&P 500 is up approximately 14% this year after returning 25% in 2024 and 26% in 2023. The forward price-to-earnings ratio of stocks in the S&P 500 is roughly 23 times, somewhat above its long-term average. Corporate earnings in 2025 have exceeded expectations and supported stock prices. S&P 500 companies reported year-over-year earnings growth of better than 13% for the third quarter and have now recorded 4 straight quarters of double-digit earnings growth. Next year, earnings are estimated to be 11% higher and set another record. Stock prices tend to follow earnings. Finally, and important to us, stocks we consider to be of high quality remain available at reasonable prices. Today, we can buy powerful, cash-generating companies such as General Dynamics, Thermo Fisher Scientific, Taiwan Semiconductor, and others at attractive prices. In our view, these companies are available at a discount to their intrinsic value, and many pay dividends that will grow over time. We believe the stocks we own will provide solid returns over the next few years. Thank you for listening.